Yeah, so the first thing that I wanted to bring to the attention of your audience, because I know a lot of them probably have fixed rate debt or a fixed rate mortgage, is make sure you don't give that up. Make sure you don't give that up. And my rationale may sound a bit odd. It's not because the government is printing money and therefore we'll have inflation, and the money supply is going to go up and therefore we're going to have inflation, which is going to reduce the burden of your debt and you're going to be paying it back with cheaper dollars. And how many, I mean, just as a show of hands out there, how, including Jason and Kenny, how many of you have heard this, that the government is printing money and that the money supply is going to increase, and if the money supply increases, then we have to have an equal amount of consumer price inflation. Like Milton Friedman says,
Yep.
inflation is always and everywhere a monetary
phenomenon. Yeah.
Right?
Yeah.
Well, what I want to do is I want to try to educate your audience and show them that this is absolutely false. And
all right, fire away.
But what I want to do and what I'll conclude with is showing them as to how is why the decade of the 2020s will most likely be even more inflationary than they had assumed coming into this conversation. Even though I think that in 2023 we could get some disinflation and some maybe even some deflation, depending on how bad the market gets. But let's start by going over a chart here that I think is really going to surprise you guys. I'm actually really excited to show you guys this.
Let me put that into the screen here. There you go.
So just let me know if you guys can you see the chart?
Yeah.
Okay, so so this black line represents M2 money growth, M2 money supply. The blue line represents nominal GDP, and the red line represents consumer price inflation. So let's look at this. I mean, between this time frame, we had the money supply, as measured by M2, increased by 423%. 423%. And this is from 88 to 2019. So, as you would assume, money or inflation is always and everywhere a monetary phenomenon. We had 120% CPI. In other words, prices went up by 120% during this time frame, and nominal GDP went up by 327%. And again, that's not adjusted for inflation. So you say, well, George, there you go. Look, the money supply increase, all this fiat currency, which is theft, it's stealing purchasing power away from everyone. And it's all a result of the Fed and the government just printing money. Money printer go burr, right? All right. Let's go back, exact same time frame, about 30 years, from 1867 to 1899. Now, Jason, can you see this black line? How much did the M2 money supply increase back then?
It is very small on the screen, but a lot.
Okay, so I'll tell you, 400%.
Yeah.
So basically, the exact same as.
Oh, I got a bigger screen now.
That we just saw, but this time we did not see, call it 100 and whatever it was percent CPI growth. We saw negative 45%. Negative. That means from 1867, call it, to 1899, prices went down by almost 50%, when the M2 money supply went up by an equivalent amount of 400%. So if there is this one-to-one relationship or a fixed relationship, where if the amount of currency units in the real economy, let's say, goes up by 5, and therefore the inflation units will go up by 1. Therefore, if we take it to 10, then the inflation units will go up by 2, right? We can prove just with these two charts that is completely false. It's not always true. In fact, it's very rarely true. And I could show you that throughout this entire timeline. If we went to the 1930s, in fact, let's do that. We can go 1930s to 1930 to 1960. That rough 30-year time frame. And what do we have here? We have money supply growth, 400%. We have CPI, 75. Again, completely different. You
Yeah.
got the exact same M2 money supply growth, but 3 completely different levels of inflation.
Okay, so what is your thesis then? Why is it different with M2
Well,
growing and inflation responding sometimes and not on others? Why?
because there has to be another variable. That's the punchline,
Yeah.
right?
Yeah.
So what is the variable?
Okay.
What you learn when you study the data is that consumer price inflation isn't necessarily a result of an increase in M2. It's a result of an increase in M2 above and beyond real GDP growth. So if you've got an increase of 400%, but you've got an increase of real GDP by 300%, which is what we had in the late 1800s, you see a price decrease of almost 50%. But if we fast forward to this time frame as an example, we see an increase of roughly 400% M2, but we only see an increase in real GDP of about 200%.
And what
Therefore,
years are you on now? Were you talking about that?
roughly 1930 to 1960.
Okay.
That 1961, so roughly that 30-year time frame. So then you would expect, since GDP, real GDP growth was lower, but we still had the same M2 increase, you would expect CPI to be higher, which it was. And you can go through any time frame you want as far as this 30-year time frame, and you'll see the exact same results. So then the question becomes, well, how do we figure out what real GDP growth is going to be? And that's where we go to this next chart.
Okay, so before you leave that though, I think one of the big factors here, George, is that M2 doesn't count credit supply. It's and you see the growth of credit that really took off in the
How does
60s.
M2 not how does M2 not account for credit?
Well, it's checking accounts and
What is
cash.
credit?
Well, credit is ability to borrow.
Right, but you borrow what?
Well, you borrow money, but the
Borrow
money
dollars
doesn't. Well, fair enough, but the
that
money
goes into
doesn't.
someone's checking account.
Yeah, sort of.
Not
Okay.
sort of. If I lend you $500,000 as a bank, that
Yeah.
goes directly into your checking account. Let's say you use that money to buy a house.
Yeah.
That goes into the seller's checking account or their savings
Yeah,
account or a
but
money
the
market
way
fund.
the way
And that's
that
picked up by M2.
transfers through the economy is there's a cut, at every level of that exchange, and that's why velocity is important. But okay, go
How is
ahead.
there a cut?
Well, every time it changes hands, the velocity increases, right? So there's more
We're talking
velocity of
about
money.
M2 money supply.
Right. Yeah.
That that
So
that that's credit.